again. This time we're looking at what we call fixed and variable costs in business. Last time we spoke a little bit about revenue and why your profit wasn't actually profit yet. Now I want to explain what I mean by that. If we take our simple business here of selling blue hot dogs and we sell them via our blue hot dog van. Of course you can see at this point why I don't do art and actually do finance instead. If we were to sell our hot dogs for say £3, straightforward enough. If we were to say that the bun, the dog itself, the mayonnaise, the bits and pieces that go with it cost us about £1 in materials, I'm sure that you would jump to this point and say, well, that's okay, we're making £2 per hot dog. Which, on one level we are. But actually, of course, it doesn't take much to realise that that doesn't pay our bills. If I was to just sell one hot dog in a year, the £1 certainly wouldn't cover the cost of insuring my business. So what we're talking about at this point with that £2 is a contribution to paying our fixed costs. It's not actually profit. Those fixed costs would include things like insurance and rent. Possibly we could include advertising in that if we wished. These are all costs that we have to pay in business that don't alter relative to how many of our product we sell. They may well go up and down. Interest rates, for example, goes up and down, but that's not relative to the amount of hot dogs that we're selling. What we're talking about is it's fixed relative to the hot dogs. If you think about it, your car, it's very similar. With your car, you have insurance and you have tax each year. Now those might go up and down, but they don't go up and down relative to how many miles you're driving. Those are fixed costs of running a car. The variable cost of running a car, in other words, in this case, the equivalent to our hot dog bun, is of course the petrol. So we have a fixed cost, something that doesn't alter, and a variable cost, something that goes up and down relative to sales. Now, doesn't take a lot of imagination to work out. I could very easily spend £10,000 a year on fixed costs running my little van. So let's just call that £10,000. That's a combination of rent, of rates, of insurance, of various bits and pieces that I have to pay just to keep my little van in business. If I'm doing that at £10,000, and I'm making £2 a burger, it's quite easy to see that basically I'll need to sell 5,000 burgers just to pay for the cost of running my little van each year. That's 5,000 burgers before I make any profit. Remembering back as well to what I said in the previous session, of that we need to think about what we might be paying in tax. And we often estimate that it's an idea to knock off 25% for tax. So actually I'm not really looking at £2, I might be looking at something closer to £1.50. And by the time I divide that through with £10,000, you can see there's an awful lot more burgers and hot dogs I have to make before I can get close to calling something profit. So just to summarise there, we have a combination of sales, fixed costs and variable costs. Sales, fixed costs and variable costs. And it is only when we've paid all of the fixed costs that we can talk about having made a profit. In the next little video, what I want to show is the simple way in which we show this on what's called a cash flow forecast, and it's almost certainly something your bank would ask to see.